Why are you confident that, in fact, if there is this substantial corporate tax cut, it will go into investment in plant and equipment?
Well, actually, so fact check, that was in Washington, not New York, because I spoke at the same conference. And I asked a similar question, and I got more hands. So maybe that my question was better posed. I don't know. But the fact is that there's a big empirical literature that shows that when countries around the world have pursued tax bills like the one that we're watching the vote count on right now, that they've seen surges in capital spending and surges in economic growth. At the CEA, we put out a report a couple weeks ago where we reviewed that whole literature and said that we could expect to have 3 to 5% higher GDP 10 years from now because of all of the capital spending that would happen just from the corporate tax side of this bill. And so Gary was exactly right to ask the question, and maybe if people thought more about it, they would have all stuck their hands up, because the evidence is that they're going to go out there and they're going to act on this.
I think you're referring to those countries as Eastern Europe. Is it fair to make the comparison with the U.S., and don't you need to look back at U.S. history for that?
No, in fact, there's a massive amount of econometric work on U.S. history. I've written papers myself. There's a paper with Glenn Hubbard in the Brookings papers and so on, where we looked at the '86 Tax Act and the user costs of capital changes and how it affected investment. And so there's a massive amount of literature within the U.S., across U.S. states, across countries and so on, that shows that lower corporate taxes lead to surges in investment, and those surges in investment increase productivity and wages.
No question, Kevin, that investment in plant and equipment and more productivity would be great for the country, and we would really promote growth. Is this the most efficient way to do it? Because there are a number of economists I've read as well who say there is something called leakage. Some of the money will go into investment, a fair amount of it will go into dividends and stock buybacks, and that will go ultimately to the owners of the company, as it should, but those are the people who already have assets that are appreciating quite nicely. Thank you, man.
So what's going to happen is that the statutory corporate tax rate will benefit new capital and old a little bit, and the expensing will only benefit new capital. And so, on balance, it's a new capital-focused bill. On the individual side, there's a big tax cut for small business, which is where a lot of the entrepreneurship in society begins. And so I think that on net, it's the new capital, the new investment that's most stimulated by this bill. But it is true that if you're some firm that's existed forever and makes a little bit of money every year, then you'll benefit some from the lower statutory rate. And that's the leakage that you're talking about.